In this video, I will be discussing Year 2 and beyond consolidation work papers and the cost method. Remember a few videos ago when we said that the cost method required a special entry starting in Year 2 after acquisition? Well, it's finally time to talk about that. Under the equity method, we record the parent's portion of the subsidiary's income, but under the cost method, we just ignore it. Therefore, under the equity method, this income accumulates in the parent's retained earnings, but doesn't under the cost method. The entry to establish reciprocity, or convert cost to equity, is essentially a catch-up adjustment to put subsidiary income into the parent's retained earnings. This catch-up entry allows us to make the rest of our eliminating entries in a way that is comparable to what we'd already learned for the equity method. If you're confused and kind of hate this, don't worry, you're in good company. We'll try to get enough practice that it starts to feel natural eventually. I do have some good news though. The work papers themselves aren't going to get any more complicated than they were in the previous video. Let's take a look at the example and get to work. This example is a continuation of the example that we started in the previous video. We've just moved 1 year farther into the future, but it's the same transaction with the same parent, same subsidiary. Because of that, our computation and allocation of differences schedule has pre-populated from our previous example. Remember that our computation and allocation of differences schedule is prepared on the date of acquisition and doesn't change. So even though we're going to refer back to it, we don't need to recalculate it when we consolidate subsequent years. We do need a little bit more information to move forward in time though, because as time has gone on, our parent has bought and sold things, our subsidiary has bought and sold things. And so now they have two new sets of trial balances. So we have a brand new trial balance for our parent company, and we have a brand new trial balance for our subsidiary company. Remember last class, we talked about how we need to take these trial balances that are arranged as debits and credits and turn them into financial statements. So I've got our split screen going on again with the next tab, which has our worksheet. And I've already arranged our trial balance into our financial statements over here. So you can see our income statement accounts right here are up at the top of our income statement. And then our expense accounts down here are next in our statement. So we have arranged everything there. You should take a minute to review that. And I've also made sure that our balance sheet balances once I've done that. If your balance sheet doesn't balance, something's gone wrong with inputting those accounts. Next, they would like us to identify our eliminating entries. So again, we're going to try to figure out what goes in these adjustment columns over here. So remember in this example, our parent company is using the cost method to account for their investment during the year. So we need to go through our 5 steps. First is to eliminate any intercompany transactions. In this case, we don't have any intercompany transactions. Again, most of our examples won't have them, but I want to keep reminding you to keep an eye out for them because you might run into them. Our next one is to eliminate any current year income of the subsidiary recorded by the parent. Now, remember, under the cost method, we don't record any income from the subsidiary. So normally we skip this one. In year 1, we skip this one. However, this is where that entry to establish reciprocity or convert cost to equity finally comes into play. So remember, this is going to be a catch-up adjustment where we're going to take our share of the subsidiary's income and plug it into our parent retained earnings to kind of catch up. So the first thing we need to know is whether the subsidiary's retained earnings has increased or decreased since the date of acquisition. So on the date of acquisition, the subsidiary had retained earnings of $23,000. We can find that in our computation and allocation of differences schedule. And at the beginning of this year, the subsidiary's retained earnings was $29,000. So we know that their retained earnings has increased since the date of acquisition. So if the subsidiary's retained earnings is increasing, that means that we would have increased the amount of retained earnings that we recorded on our parent's book as a reflection of that income. We also would have increased our investment in S because as they record positive income, we increase our investment in S. As they record dividends, we decrease it. So if it's a net positive, our investment in S would be bigger. So we know our catch-up entry is going to write up investment in S. And it's going to also write up 1/1 retained earnings of the parent. All right, then we have to figure out how much. So again, we want that increase in retained earnings. So we're looking at retained earnings at the beginning of the year that we're consolidating, which is in our trial balance here because we have not yet closed out our income statement accounts to retained earnings. So that's a beginning of the year balance minus what it was on the date of acquisition. And what it was on the date of acquisition will be memorialized in our computation and allocation of differences schedule. So we can always head back there to find it. Now, we're not quite done because we wouldn't have recorded that entire $6,000. We would have only recorded our share. So I'm going to throw some parentheses around this and multiply it by our ownership percentage, which is the 95%. So our entry to establish reciprocity is going to increase investment in S by $5,700, and it's going to increase 1/1 retained earnings of the parent by the same amount. Okay, now from this point, everything should be pretty much the same as what we already learned either in the cost method year 1 or in the equity method year 2. So we need to eliminate any current year dividends. So we know that no matter what, if it's equity or cost, our credit is going to be dividends declared by the subsidiary. Now what changes is our debit because it depends on how we recorded these dividends when we received them. So under the equity method, we would have decreased our investment in S. But under the cost method, we would have recognized dividend income. So under the cost method, we need to eliminate dividend income from our income statement. We also can look up here and see that our subsidiary declared dividends of $20,000. And we know that 95% of those would have come to us. So that is $19,000 of dividend income that we need to eliminate. Moving on to our elimination of the subsidiary equity accounts. Again, I'm going to do the account names and then talk through what the numbers are. So we know we need to credit investment in S to eliminate that asset account. We need to debit the subsidiary's equity accounts, common stock of S, other contributed capital of S, and remember 1/1 retained earnings of S. Anytime we own less than 100%, we're also going to create a non-controlling interest. And if our debits don't equal our credits, we're also going to have a difference between implied and book. And we know that because our difference between implied and book was positive, that this is going to be a debit. So the next thing we need to consider is which numbers are going to stay the same over time. So difference between implied and book is calculated on the date of acquisition and does not change. So that one is going to stay $15,421. We know that for sure. We also know that common stock and other contributed capital are going to stay the same just because our book is nice to us and doesn't want to torture us too much. So common stock will still be 120 and OCC will be $10,000. Unfortunately, retained earnings is definitely going to change over time because our subsidiary is unlikely to break even every single year and never pay dividends. So we need to eliminate retained earnings as of the beginning of the current year. Now, in the previous example, in the equity method, we had to calculate this because we didn't know what their retained earnings would be at the beginning of the year. But this time they gave us a trial balance that has the number right on it. So we can use that. It says retained earnings 1/1. So we know that that number is what it was at the beginning of the year and what needs to be eliminated. Now, this number right here, as we already saw in our entry to establish reciprocity, is different from what it was on the date of acquisition. What we're going to do is we're going to take that incremental increase and we're going to allocate it between our investment in S and our non-controlling interest based on our ownership percentages. So as of the date of acquisition, our investment in S was $160,000. We're going to add to that our share, or 95%, of the difference between retained earnings as it appears in this eliminating entry and retained earnings as it was on the date of acquisition, which can be found in our computation and allocation of differences schedule. So this is exactly the same formula that we used for the equity method. We're going to do it again for non-controlling interest. So we're going to start with non-controlling interest as it was on the date of acquisition. We're going to add to that their share, or 5%, of the change in retained earnings. So we're going to compare what it is at the beginning of the current year, which can be found in our current eliminating entry, minus what it was on the date of acquisition, which can be found in our computation and allocation of differences schedule. So that gives us a non-controlling interest of $8,721. Now, if you're paying really close attention, you might have noticed that this amount right here that we added to our investment in S is the exact same amount that we added to investment in S in our entry to establish reciprocity. That's not a coincidence. That's one of the reasons that we do this entry. We gross up investment in S so that when we make this entry, it will fully eliminate our investment in S. Our last entry here is going to be to allocate our difference between implied and book. Remember that our difference between implied and book can be allocated to fair value adjustments and or to goodwill or gain on bargain purchase. In this case, the entire thing goes to goodwill. And we know that from our last example and from our computation and allocation of differences schedule. So next what we're going to do is we are going to fill out our worksheet. So we're just taking these eliminating entries and reformatting them into these columns. First entry, we don't have anything. Second entry, we are going to debit investment in S. So it's going to be down on our balance sheet. And remember, I'm going to number my entries so that our debits and credits go together. And we're going to debit for $5,700. And we're going to credit 1/1 retained earnings of the parent. So we need to head back up to the retained earnings statement. And we are going to credit the parent for $5,700. We're going to head down to the bottom of our sheet and make sure that our debits and credits balance. They do, so we are happy. Remember that they won't necessarily balance on every statement, but they do need to balance on our balance sheet. Okay, next one is dividend income. Dividend income appears on our income statement. So we are going to debit dividend income for $19,000. And we're going to credit dividends declared by our subsidiary, which appears on our retained earnings statement, again for $19,000. Scroll down to the bottom, debits and credits still balance, so we're good to move on to the next one. Our next one starts with a debit to common stock of our subsidiary for $120,000, followed by a debit to other contributed capital of $10,000. And then a debit to 1/1 retained earnings. So we have to head back up to our retained earnings statement. And that is a debit of $29,000. Then we have one more debit. Again, don't ask me why I put this in the middle, but we need to create difference between implied and book, which will be a debit of $15,421. Then we have two credits. First one is investment in S for $165,700 and non-controlling interest for $8,721. Again, debits and credits balance, so we're pretty happy. Then our last entry is to establish goodwill. That's going to be a debit for $15,421 and a credit to our difference between implied and book for the same amount. Again, our debits and credits balance. All right, so I'm going to make this full screen so we can talk about it for a little bit. First thing I'm going to do is I'm going to go steal our formulas for our consolidated column so we don't have to do those all over again. So I'm going back to our example from the last video, and I'm just going to highlight these values, copy, and paste them over here so that it'll magically recalculate for us. When you're working on these problems, it's not a bad idea to get those formulas in early, and then you can see the effect of your entries as you make them. So again, our balance sheet doesn't balance because we haven't handled our non-controlling interest column. So we have to take our non-controlling interest and give them their share of the subsidiary's income. So remember, they only have a right to the income of the subsidiary because they only are shareholders in the subsidiary. And they have a 5% interest. So they would have, their share of the income is $2,500. That's going to flow down to the retained earnings statement, where we need to figure out their share of the dividends. So here, we're going to take the dividends that the subsidiary issued, subtract out any debit adjustments, add any credit adjustments to get dividends of $1,000 that went to our non-controlling shareholders. So that means that net, their investment increased by $1,500 when we're using kind of the equity method to account for their investment. That's going to come down to our balance sheet. We're going to bring over so let's see, do this thoroughly. Subtract anything in our debit column, add anything in our credit column, and that's going to bring over our beginning balance of non-controlling interest and calculate our final ending balance, which gives us a balanced balance sheet. Now, something to pay attention to. Again, you should do your checks. In this case, all of our dividend income was eliminated because we only had dividend income from our subsidiary, but that might not always be the case. We also eliminated all of our retained earnings from our subsidiary. We eliminated all of our investment in S, and we left no difference between implied and book on our consolidated balance sheet. And we also eliminated all of the subsidiaries' equity in both other contributed capital and common stock. Now, something that I want to point out to you is, say we forgot to do our entry to establish reciprocity, because that was that new thing that's super weird. We don't really like it. What would have happened? So we're going to delete entry 2, basically. So we're going to get rid of the entry 2 there and entry 2 up here. So on our retained earnings statement, nothing really looks all that out of the ordinary, except for the fact that we don't have any beginning income from our subsidiary. It's just our retained earnings is so the parent's retained earnings is the consolidated retained earnings, which is kind of a red flag, but it wouldn't necessarily jump right out at you. What would jump out at you is that you still have a remaining balance in your investment in S account. You now have a contrabalance. So your investment in S didn't get fully eliminated. Why? Because we forgot to do our entry to establish reciprocity. When we put it back, we see that it eliminates properly. So if you have a negative investment in S, check and see if it's cost method and year 2 and beyond. You probably forgot your entry to establish reciprocity. This concludes our lecture on year 2 and beyond work papers and the cost method. Don't forget to email questions for our discussion.